We last discussed the expectations theory to explain yield curves. We'll briefly start by discussing its empirical merit before moving on to other models which help us understand the relationship between short and long-term yields. Remember that the expectations theory assumes that bonds of different maturities are perfect substitutes. Long-term yields are then averages of current and expected future short-term yields. Remember also that there are three empirical regularities about yield curves. Yield curves co-move, i.e. they tend to move together. Higher short-term yields imply flatter yield curves, and yield curves almost always slope upward. Now, how does the expectations theory perform in explaining these three facts? It does fine on the first fact. If long-term rates are averages of short-term rates, and short-term rates increase today, the average, and thus long-term rates themselves, will increase as well. The expectations theory also does okay in explaining the second fact. The reason for this is that interest rates are mean reverting, which means they move within certain boundaries. For instance, they don't become indefinitely negative, or they don't always increase. Therefore, if interest rates have been low, say close to zero for a long time, they're likely to increase in the future. Vice versa, if interest rates are high, they're likely to fall in the future. This in turn implies that when short-term interest rates are low today, short-term interest rates in the future are expected to be likely higher, which in turn pushes up long-term rates today. Similarly, when short-term interest rates are high, they are likely to fall in the future, pushing long-term rates today down. This corresponds to steepening and flattening of the yield curve. However, the expectations theory has the fatal flaw that it predicts inverted yield curves any point in time where short-term interest rates are expected to fall. In practice, however, yield curve inversion is extremely rare, so something else is still missing here that could explain why long-term yields tend to have higher interest rates than short-term interest rates in most scenarios. One way to explain this third fact is offered by the segmented market theory, which states that bonds with different maturities are traded in distinct or segmented markets. They're therefore not substitutable at all. This is akin to assuming that investors have strong preferences for individual maturities. Typically, shorter maturities will be in higher demand since they're subject to fewer risks such as interest rate changes, and since these markets tend to be more liquid. As a consequence, their yields should be lower than those on long-term bonds by a loanable funds type of logic. The segmented market theory therefore explains the third empirical fact that yield curves are upward sloping almost all the time, exceptionally well. However, if markets were truly segmented, if there was no arbitrage, no substitutability across tenors, there really is no reason to believe that yields should co-move. If one yield moved separately from another, there's really no reason why they always should broadly move into the same direction. For the same reason, there's also no reason to believe that there should be a systematic level effect, as is the case with yield curve steepening and flattening. Now, to put everything together, the liquidity premium theory, which is distinct from the liquidity preference theory that we've seen before, states that lenders can substitute between different maturities, but they tend to have a preference for shorter maturities, all else the same. In exchange for holding longer term debt, they request a liquidity premium. In its most basic form, this is an augmented version of the expectations theory we've already seen, that states that the long-term yield here on an n-year bond is equal to an average of expected short-term rates over the maturity period. If n is equal to 2, this would be 2 interest payments. If n is equal to 10, it would be 10 interest rate payments. But this is the expectations theory as you know it. However, what drives a wedge in between short-term rates and long-term rates is this term LNT here. This is our liquidity premium. That liquidity premium increases the longer you have to wait. And consequently, it drives a wedge in between long-term and short-term yields that has a tendency to push the yield curve upward. As an example, think of a scenario where short-term interest rates are expected to stay constant till the end of eternity. In this case, long-term interest rates would be equal to short-term interest rates, and the yield curve according to the pure expectations theory here with the Roman numeral 1 would be completely flat. Adding a liquidity premium shifts the curve up. Why is that? Because the liquidity premium on, say, a 5-year bond would be lower than that on a 10-year bond, would be lower than that on a 15-year bond, and so forth. Now, how does the liquidity premium theory match the historical facts? Since this augmented expectations theory includes the features of the expectations theory, namely that long-term rates are an average of expected short-term rates, it performs fine in explaining the first two facts. Adding the liquidity premium as a nod to arguments brought forward in the segmented market theory finally helps us explain the third fact as well. Now, while this is very stylized, most modern theories of explaining yield curve behavior are based around the idea of the augmented expectations theory, that interest rates to a degree are an average of short-term interest rates, the longer they are, but that there's also a liquidity premium that issuers of long-term debt have to pay. Now, what's the point of all of this? I'm not going to go too much into this at this point, but the homework is going to explore the question why we care about yield curves. For one, if you work in fixed income instruments, yield curves are an important tool for pricing bonds or bond derivatives, which is something I'm not going to discuss too much, but it is something that you might see in a fixed income class. From an economics perspective, the reason why we care about yield curves is because they contain information not just about interest rates per se, but also about interest rate expectations. Because in part, long-term yields are an expectation of short-term yields. Now, this gives us a sense of how markets think about future interest rates, which to a degree allows us to think a little bit about where markets think the economy is headed, at least in theory. Why is that? Interest rates are mildly procyclical. It means they tend to increase at the end of expansions, and they tend to decrease during downturns. One of the consequences then is if the yield curve is very steep, it reflects an expectation of rising interest rates, which will typically be the case at the onset of a recovery or an expansion. Meanwhile, if the yield curve becomes very flat, it signals an expectation of falling interest rates, which often historically has predated contractions or slumps. Now, I'm going to be careful here and leave a word of warning here that it's not really a mechanical relationship. So you should not expect the economy necessarily to tank just because there's an inverted yield curve. But in general, all else the same, flatter yield curves are pre-shadowing lower interest rates. Problem is, in different contexts, a yield curve may be flatter or steeper for other reasons, which we'll discuss at a later point.